Ladies and gentlemen, thank you very much, Natalie. My name is Tim Hames. I'm here with 17 Capital. If you want to see any of my charming colleagues, they're upstairs, first floor, booth E002. Now, it's hard to believe and easy to forget that a year ago, January 2022, the word on the lips of most people thinking about the outlook for the global economy was, in fact, Omicron, and the extent to which that variant of COVID-19 would or would not impede the reopening and the recovery of the world economy. Indeed, it was because of Omicron that there was no Davos in January 2022, and indeed no IPEM in Cannes in January 2022. Yet Omicron has gone back to sounding like some sort of brand of microwave oven, and a whole different set of words, themes, and concerns have dominated this conference instead. But looking back 12 months is a useful reminder. Omicron actually turned out to be one of the largest false alarms in human history. Indeed, arguably, a blessing in disguise, and it sped up the development of the virus into something which was more infectious, but less deadly. So, is history going to repeat itself with macro trends this time around? To help answer that question, I have assembled a panel of genuine superstars who I invite to briefly introduce themselves and their institutions.
Yeah, so Harry van Rijbroek, feel flattered by calling me a superstar, but we have at PGGM, it's a Dutch pension fund for the healthcare sector. We run a 23 billion private equity program, which is all across the globe, both in primary fund commitments, co-investments and secondaries. So quite a diversified program. And it's going quite well, I have to say, at the moment.
Anuj Ranjan. I'm the president of the private equity group at Brookfield Asset Management. We manage about 750 billion of assets around the world, about 100 billion in private equity.
Hi everybody, Carl-Johan Elström. I am with EQT. We are a global diversified player in active management strategies. So we have approximately 210 billion euros of assets under management. And I've been with the firm for 14 years. The last 2 of these have been focused on setting up our impact-led strategy, EQT Future.
Excellent. So I'm going to start by asking a few big picture questions to all of the panelists. I'll then move to some specific ones relevant to their particular spheres, and then encourage you all to pile in for the last 8 to 10 minutes and questions about anything you like whatsoever. But let me start with the obvious big picture questions. To what extent should macro concerns force a change in your approach, or should you seek to invest through the cycle regardless, whether an LP or a GP? Should the denominator effect really be determining your decisions? Start immediately next to my left.
Yeah, we have, of course, the denominator effect in our portfolio. So we are now 10% of the assets under management of PGGM. It should be 6.2%, so it's a little bit just over the target, I would say. But we continue with our program as it more or less is. I think we made once, a long time ago, a mistake by skipping one vintage year, which was the best vintage year in history. I think we learned from that, and that's also what you now see in the decision we made for 2023, that despite the overexposure, we just continue the program. And I think that means we invest regardless the macro trend.
Yeah, I'm very happy to hear what Harry said, because I agree 100%. We think this is the best time to be a value investor. Putting capital to work in private plays right now could be a great vintage looking forward. We've changed nothing about our investment strategy. We like to buy great businesses, acquire them for value, and make operational improvements that enhance the cash flow and generate our returns. It's exactly what we're doing. And in fact, in this exact environment, we think it's a better time to be more active.
Fine.
Yeah, that resonates a lot from an EQT perspective as well. So we're a thematic investor. We look for, you know, unstoppable megatrends, sustainability, digitalization, etc. Find the market leaders in those industries and then help them transform their respective industries. So what we've seen historically through crises is that these type of businesses tend to have very robust valuations also through the cycle, and they tend to come out stronger on the other side of volatile times. So we stick to our guns, same investment philosophy, but perhaps a bit more selective on where to go in, and even more razor focus on applying all the tools in our value creation toolbox in actually developing the companies.
Well, let's build on that remark for the second question, really, which is to what extent more challenging times either lead you to say, we retreat to our core, we do what we know we've done best for a long time, or acts as spur for a degree of innovation in the sense that selectivity alone is an active innovation?
Yeah, we stick to the core. I think we are good in what we are doing at the moment. So it's not that we can immediately change. It's also given the fact that the client gives us a mandate which stipulates that we have to do X, Y, Z. And especially in our case, it means buyout investments and growth investments. And it's not that you can easily change overnight the program. So for us, it's stick to the core. I think there our team is also the best equipped for at the moment. So that's our view.
Likewise, I would say we follow the exact same playbook, which is we've always prioritized cash flow in businesses that we acquire. That's still the case. We like to buy high quality businesses for value. The only key difference is I'd say the universe of what is a high quality business that you can acquire for value has expanded. And so we're possibly buying slightly better businesses today than we were in the past, which might need less work to improve than we had in the past.
Yeah, we're also sticking to the core. I mean, we have some 50 billion euros of dry powder. At the same time, you know, it takes longer to raise new money. So we'll dig deeper where we currently stand, and I think it will be a great vintage. I think looking back at the great financial crisis, some of the absolutely best deals in EQT's history were made in the wake of that. So, yeah.
Okay. Even before the sort of mood shift that we witnessed the last sort of 8 to 9 months of 2022, the whole question of continuation funds had been a potential source of tension, at least between some LPs and GPs. If we have a prolonged period in which exiting at attractive prices is more difficult, presumably the issue around continuation funds intensifies. Is that going to be the source of some grief, shall we say, between LPs and GPs in the year ahead, do you think?
Yeah, I think if you look at all the continuation funds which we are now seeing in the market, it's quite astonishing, I have to say. It's also sometimes we have, especially in LPAC sessions, you see that there is a little bit of discussion around price setting. I think several GPs are relatively easy in immediately going to this continuation vehicle setup and preparing an exit process, which is only, where you only have secondary players participating in. Then the question is, of course, do you get the best price? And I think that's, for us, it's one of the big issues in those discussions. Another issue is about, it's another fee income generator for the GP. Typically, there is no status quo option, what you see in the market, where we are really favoring that one, and we will push for it, also in future discussions with GPs, because you want what you want is that you can make also the decision to just continue with that investment as the GP does, at the same, let's say, cost what it was before it went to the continuation vehicle. So we don't see any need to pay much more for that continuation vehicle setup. So I think there is a lot to say also for continuation vehicles. But what I just said with those two remarks, I think you have to be a little bit careful as an GP.
Yeah, I would agree. We have never set up a continuation vehicle before, so I probably should be careful what I say. Maybe my comms team is. I don't want to say anything wrong, but we've never set one up
everything
before.
Everything is filmed in this place.
Yeah, I think we prefer we prefer to we have a lot of time in these funds. We buy businesses, we improve them with our operational capability. It's better to find a strategic or another buyer in the universe out there, and we all have time usually in our funds to hold them a little bit longer through periods like this just for that reason. So we have so far preferred and always do usually exit to just third parties.
The only thing to add to that, I think from an EQT perspective is, the only situations where we would look to continuation vehicles is when we have such a great asset that we just think it's in the best interest of both the LP and the GP to ride it for longer. So riding the winners has been really successful for us in the past. And I think in a time of uncertainty and quite large bid-ask spreads out there in the market, I think it's actually a fantastic risk-reward also for LPs to continue to ride companies where we as a GP have been on the inside for, say, 10 years and know exactly how to create value going forward.
We may come back to that in audience Q&A, because I think that'd be an interesting theme. So if I just ask one or two questions of you individually, starting with the next to me. Harry, you said that you were reasonably relaxed with being at 10% when the sort of theoretical model is 6.2%. But then, you do oversee the private equity bit of your empire. I wonder whether your colleagues are equally relaxed. And I also wonder whether there's a sort of element here in which investment professionalism and street common sense rub against each other. In that if I was to stop any ordinary person walking down the street of Cannes, not that I think there are many ordinary people walking down the streets of Cannes, and say, there's a bunch of investment experts in there, and what they do when something is doing really well compared with other things is they cut back on it. I think they'd be quite bemused. So what's the internal debate like about how much is too much private equity?
Yeah, that's a good question. I think just before the denominator effect kicked in, I think we had already quite a lengthy discussion with the client about increasing private market exposure because they liked the categories. So it's not only PE, but also infra and real estate, for example. So I think there was already a nice discussion for increasing these asset categories. I think what you now see with the denominator effect is more the need for liquidity in the end of the pension fund. There is a little bit of tension because I think there is still a case to make to increase private equity exposure, hence to be a little bit relaxed with also with an exposure of 10%. But on the other hand, you have regulator effects like, yeah, you need liquidity in the end. And that's a little bit a typical Dutch thing, probably. But it kicks in the discussion about whether we are relaxed, yes or no. I think at 10%, we have to come down in the end, that's for sure. But you can't spread it out. It's not that you have to do it to realize it immediately within 1 year and you have to go back to 6%. So what you will see is we will take the time to go back to 6%. And in the meantime, we hope that public markets will recover a bit. That helps a lot.
Yeah. And equally, you have historically, you're a very large institution, I think second largest pension fund in the Netherlands. You've historically focused on the European mid-market within private equity, whereas others of your peers, very large LPs, have either for either out of choice or they feel out of necessity, preferred to write a smaller number of larger checks. So would you be sticking with a European mid-market strategy, or is there a sort of gravitational pull that's sort of dragging you in the direction of larger organizations? Yeah.
It's a little bit probably a kind of misunderstanding. So I am responsible for the European mid-market.
Right.
So that's so I'm always in favor of investing in the European mid-market. But we are in general a PE investor worldwide. So we invest also in the US, even more in the US than in Europe at the moment. So it's 50% US, 40% Europe, 10% rest of the world, which is especially Asia. And writing bigger tickets, yes, to a certain extent, we also looking into it, but it's more from a manageability of the PE portfolio than something else. Because what you see is adding a lot of more managers means also a lot of more work, and you need a lot of more colleagues to run the portfolio. So I think from that point of view, we are always a little bit looking to concentrate. But I think that's more or less it. Yeah.
Okay, that's very kind. Thank you. Anuj, I suppose if there's been a sort of vague consensus out of day one about how people are looking at macro trends, the phrase cautiously optimistic has sort of recurred quite a few times. But supposing we should instead be cautiously pessimistic, and we're in for perhaps 2 years in which both fundraising and exiting at attractive values is very challenging. How would that affect your ambition, the stated ambition of Brookfield, and perhaps expand on it to be a, quote, value investor?
Sure. So, and I'll start by saying that, Harry, if you ever do want global diversified managers, so I'm happy to have a conversation. Jokes aside, I'm in the optimistic camp. And it's exactly as you said in the end there, being a value investor, there couldn't be a better time. This is, we think, an incredible opportunity to buy high quality businesses. Cash flow is back in fashion. We were never really betting on excess leverage or excess growth to begin with. Most of our returns have come from margin expansion, not multiple expansion. And so we feel pretty good about buying good businesses that we can go and implement pretty aggressive operating plans. And so I just look at the transactions we've done in the last 6 months, and these businesses are, I think, better quality than what we were able to get even a couple of years ago, where we can implement the operating improvements, frankly, faster. So we're very happy from a, I guess, more micro perspective with our strategy. We're quite excited. And even when we look at the macro trends, I'd say overall, we feel better about economic prospects than we did before. It's not that we don't think there's a global recession coming. We agree there is one. But the depth and the breadth of it, we think, will be shallower than originally thought. China reopening is bringing a lot of, is going to have a lot of impacts on the economy right at a time when the world kind of needs it. The excess savings alone, just the excess in the last, over the pandemic in China is $2 trillion US. And that's going to have a huge impact on, I think, economies around the world, and specifically domestically as well. We feel like Europe has not been as bad as we all feared, partially because the energy prices have retreated. And so that's been better. And we think there's more reason for good news ahead than bad. But the valuations that you can acquire things for today are still quite depressed. So it's that perfect mix of the world doesn't look as bad, but we can do great deals.
Okay, well, let's broaden that theme out, because you, like the gentleman to your right, invest in both North America and Europe to a significant degree. Now, the opening keynote address yesterday morning from the chief economist at Allianz, which was remarkably clear and direct for an economist, basically argued that there was a fundamental difference between the US and Europe in terms of where interest rates were heading, that the Fed felt that a large part of US inflation was overheating and were prepared virtually to engineer a recession to get it out the system, whereas the ECB saw inflation as much more cost push, particularly energy prices, and was going to be rather more gentle on interest rates. So if we have a significant divergence between interest rates in the US and Europe, does that impact your thinking, or do you regard that as a pretty short-term thing, 12 to 18 months, and it shouldn't really sort of corrupt your calculations?
So, sorry, okay. Look, I'm not a macroeconomist, but Mark Carney's our chairman. He's a macroeconomist, and I trust what he says more than myself. But I would say our view is the ECB will catch up. It might be a little bit delayed, but everyone is, some countries are a little bit ahead on the hiking of interest rates, and some will do it a little bit later. The world will get to around the same place, so we do think it will catch up. Not all of the impact of the rate increases that have happened so far have been transmitted yet to the real economy. So the real economy should still, we don't think there are 10 hikes left in order to achieve what everyone wants to achieve. And we think that in the next 2 to 3 quarters, we should see the peak of it in most places. So I'd say we think of it as a shorter term phenomenon. We all will get to the right place. The recession will be engineered, and thankfully it will be, we believe, shallower than everyone first thought.
Splendid. So I go to Carl. First of all, wearing your macro EQT hat, you're a very large fund. You have significant dry powder. What's the internal debate about either sitting on it, because you're not obliged to spend it instantly, or spending now in the belief that we're quite close to the bottom in terms of buying?
Yeah, so we sit on approximately 50 billion euros of dry powder, and we're more selective than a year ago. But despite this, we are continuing to deploy that money behind very strong pipeline focused on these unstoppable megatrends that I've mentioned previously. So sustainability, digitalization, etc. So we will invest through the cycle, and I think the best deals will be done now.
Okay. Now, you mentioned that the last 2 years at EQT, you've been involved in creating the impact investment fund. The last time we had global economic turbulence of this sort, 2008-9, there weren't actually very many impact funds out there at all, and certainly not ones many associated with sizable institutions such as yourself. So to what degree do more challenging economic times, or the perception of more challenging economic times, create more complications for someone like yourself trying to establish impact investment funds when you're already dealing with slight skepticism about whether it's possible to do good and do well simultaneously anyway, but you're having to persuade people you can do good and do well in conditions which aren't ideal?
Well, I think EQT Future is our most recent initiative. It's an impact-led strategy. We are focusing with that fund on investing behind really solving the big challenges within climate and nature and health and well-being. What we do on top of that is that we focus very much on downside protected businesses. So businesses that are already out there, thriving, growing, profitable, cash generative. And these type of businesses tend to stack up really well through the type of turbulent times that we have now. So I don't at all see that type of skepticism anymore. I agree there was skepticism 2 years ago when we started fundraising, but I think now everyone is seeing how impact and profit goes hand in hand. And all the companies that we do invest in, we see that on a portfolio company level. So a company that is transforming their respective industry, taking it from, say, brown to green with a sustainable solution, that customers are prepared to pay more for. That's what we see in all our investments in EQT Future. So that means, more impact comes with more profit. So I think we've, completely decoupled from this perception that impact need to come at the cost of returns. That's not what we're seeing in our portfolio, which is performing on or above plan for all our investments. And it's not the sense that I'm getting from the LP meetings I'm having here yesterday and today.
Excellent. We've got some time, so and we've covered up some broad topics. I've got some questions in reserve if necessary. But are there any questions, comments, observations from the audience on anything any of the panelists have said so far? What I sense telepathically the audience would like to know is, of the array of macro indicators that you could be looking at, interest rate levels, inflation levels, unemployment in terms of consumer demand, is there anyone in particular that's the sort of lodestar in terms of your own thinking about the economic outlook over the next 12, 18, 24 months? What's the one number that interests you most? Starting with you.
Difficult question, I have to say. For me, I think interest rates are really a key element, and that all has to do with the impact it has on the pension fund itself,
Right.
and hence my allocation in the end. So increasing interest rates at the moment, which I don't expect, as was also mentioned here on the left-hand side for me. I think if you look at that, I guess it's that's for me the big topic, and I hope they will come down or at least stabilize a bit. That will certainly help in my case.
I would agree. If I had to pick one, I agree it's a tough question, but I would pick interest rates as well, because in our view, look, while money should never have been free, probably, so having some, having interest rates in the 4s or even the 5s is probably not, it's not the end of the world, and I think we will get to a reasonable place. But if interest rates were double digit, for example, that's not good. So none of us expected, I think, to get there, but that is probably the one indicator that we, would pay a little more attention to.
I think the phrase double-digit interest rates, that's not good, qualifies as understatement of the IPEM conference 2023. Collect your prize now. Carl, how about you?
Well, of course, inflation is an issue, but our businesses tend to be so strong that they can pass through a lot of that. I think one of the challenges that we are facing across the portfolio is the disrupted global supply chains. That's something that we're still struggling with, and something we keep a very close eye on.
Very good. Another chance for anyone in the audience to offer question, comments, abuse, anything at all, really. Okay, well, to close out, let's close out where I was trying to tempt you in the introduction, which is going back to Omicron, which turned out to be actually an enormous false alarm. But people genuinely, European society locked down for longer because of the fear of it. It was really out there a year ago, and now it's virtually a Scrabble word. Do you think in a year's time, we reassemble in Cannes, January 2024, we'll be asking ourselves, why was the mood so nervous and fractious 12 months ago?
I'm not really nervous at the moment, so that's at least. So I try to be that also in January 2024. I hope to be not that nervous, but I can see there is a lot of changes, I think, in the world at the moment, especially also today, with probably tanks being delivered to Ukraine. That can also have maybe consequences on the battlefield over there. I hope it will finish quite soon, that war. Also, given the fact that it has quite some impact on all kinds of economic conditions, also here in Europe. It also is one of the reasons for the high inflation, for example. So there's a lot going on, and I hope we are less nervous next year. And I'm definitely not yet nervous.
Yeah, I'd say I'm fairly optimistic. I hope to still be optimistic next year, but I'd say as the world's a little nervous, I suspect the things we're nervous about today, we won't be nervous about next year, but there'll probably be a few new things. So,
and finally, Carl.
Yeah, I think we'll look back at this time and see that the absolutely best deals of our generation were made in the next couple of years here. At the same time, short-term denominator effect, sure, but I think if you take a global perspective, a lot of LPs are still under-allocated to private equity. So I'm recklessly optimistic about the future of the industry.
Excellent. Well, on that supremely stimulating note, can I invite you to show your appreciation for what's been a very, very lively panel. Thank you very much indeed.
Thank you.